Those questions is Fundstrat's Tom Lee, a CNBC contributor, of course. Tom, good to see you. Happy New Year.
Happy New Year to you.
So first off, Tom, what's your diagnosis of what the market's been contending with here in the last several weeks as we've gone sideways and had sort of this negative skew toward market breadth?
Markets kind of did flail into the end of last year and the first day of 2025, and I think it was trying to digest a few things, that the pretty dramatic move in long-term yields and the dramatic drop in yields in China. I think that there has been some concerns about macro as you saw some events over the past few days. And I think there was general profit taking and some sort of like, let's wait and see how 2025 is, given we just booked two 20% back-to-back years.
And do you think that those things will remain overhangs? I mean, obviously, you certainly have a bullish orientation. You feel as if the S&P 500 can get to 7,000 by mid-year before perhaps a pullback. Well, if we're getting from here to 7,000 in less than 6 months, you're talking about, 35% annualized pace of gain. So how do we get there?
Well, I think one thing the viewers need to keep in mind is that just because the calendar year changed doesn't mean that the strength that we saw throughout 2024 suddenly has evaporated. There are tailwinds building because the Fed is dovish, even if they're making fewer cuts. But I think one of the sort of two important things happening early in 2025 is going to be, one, we are seeing manufacturing recover. The ISM manufacturing, posted one of the highest readings in almost 2.5 years. I mean, it's been below 50 basically for nearly 3 years. And the second is that I think the labor market could be softening in a way, because whether you look at link-up data or the ISM employment, to tell us that the Fed now has to be focused back on supporting the economy. So I think this month could be quite decisive in the sense that we've got weakness because of some insecurities building, but I think it's, the same tailwinds are in place. I mean, I think it's still a buy the dip kind of market.
And in terms of perhaps the same themes being in place, does that mean that the leadership profile of the market you expect to stay similar to 2024? I mean, I know it's waxed and waned between mega cap growth leadership and then some broader participation, but we did finish again with dominance by the NASDAQ 100 type stocks.
Investors still are going to pay for earnings visibility, and that's why I think the Mag 7, including NVIDIA, are going to be important holdings. But financial conditions should ease this year. Easing financial conditions does allow some cyclicals to post better earnings growth, like financials and regional banks, industrials, and small caps. So I think that there should be a case for broadening of the markets this year. And then finally, I think in terms of risk appetite, still one of the good measures to look at how risk appetite is to look at something like Bitcoin. And at 97,000, it's still telling us that, this is still a risk-on market.
Yeah, I mean, obviously it's held almost all of its gains since that little poke above 100,000 in Bitcoin. Although I do wonder what you make of the relatively heavy outflow we were seeing in the BlackRock ETF that holds Bitcoin, whether it was just sort of deferred profit taking into a new tax year or something else.
It's hard to tell. And I think with the ETFs, it is creating, I think, an interesting dynamic, which is that someone who sells a BlackRock ETF doesn't have a 30-day holding period if they buy another Bitcoin ETF. So I think in some ways you can see people doing basis swaps and stepped up in tax optimization strategies and not really having to worry about that 30-day holding period.
Right, the wash sale rule. Yeah, no, that certainly would make sense just as tax planning and a tactical basis. Again, on small caps, I mean, it feels as if we've had these false starts in terms of the comeback for smaller stocks, and many theories fly around as to whether you really need market bond yields to go down, you really need the Fed to get more aggressive, or you really need it to look like the start of a new cycle as opposed to the continuation of an existing one.
Yeah, small caps have been frustrating because there have been a lot of rug pulls, especially last year. I've been disappointed that small caps haven't sustained gains. But we know earnings visibility is better this year. You can look at either bottoms-up numbers or median EPS growth. And not only are they accelerating for the Russell 2000, they're still almost, at least at the index level, 2,000 basis points higher than the S&P earnings growth. So I do think this is a year where, as long as the Fed is committed to getting towards neutral, So that's a caveat because, of course, if inflation reaccelerates, small caps should really be an important beta play to that easing of financial conditions that follows.
And just in terms of what have seemed to be perhaps headwinds or causes for investors to pause a little bit in terms of seeking risk, the 10-year back to 4.6% or so as we speak right now. Of course, you've had this massive ramp in the dollar. Both those things could be occurring for relatively benign or even outright good reasons. But it does seem as if the equity markets need to sort of figure out if they have the chance of being a little more hazardous.
That's right. I think investors understandably get leery when they think that there could be a 5% on a 10-year, and that means investors kind of sit on their sidelines and see if the markets can handle it, if it doesn't damage the economy or companies, and then eventually, our expectation is that investors are going to be okay with even something like a 5% 10-year, just because that's still a 20 PE for a risk-free bond, and existing equity PEs can actually go up, but of course, it'd be better to see 10-year yields closer to the low 4% than 5%.
Right. Yeah, it seems like that's where equity investors are slightly more comfortable, though. Again, you can kind of make your piece at different levels. Tom, back to you in a second. Let's bring in Jason Snipe of Odyssey Capital Advisors and Megan Hsu of Wilmington Trust. Jason, of course, a CNBC contributor. And welcome to you both. And actually, Megan, before we get into the whole big picture backdrop, I did want to bring up something that Richmond Fed President Tom Barkin said today, and it gets at this whole idea of the interplay between growth expectations, Fed policy, and interest rates. He essentially was pretty positive on the growth profile in general, and essentially saying, we can stay restricted for a little while longer. It's a very wait and see type of message. He expects more upside than downside in terms of growth. Labor market more likely to break toward hiring than firing. And, bond yields did lift after this. You happen to think, Megan, that perhaps the Fed is going to have to be forced to do more cutting. Why might that be?
Yeah, and I think that Bargan's comments do summarize generally the gist of what we've gotten in terms of the tone from the Fed of late. And our view is that relative to consensus expectations, we are a bit more concerned about growth and a bit less concerned about inflation. We just do not see the ingredients needed to have inflation materially reaccelerate. We think it could be sticky on a year-over-year basis, but will continue to trend lower. And in fact, we're a bit more concerned about the state of the labor market and the state of the consumer, which on the surface has been very strong. But as Tom mentioned before, if you look at some real-time job opening data, JOLTS and different metrics of job openings, they are plummeting. We're really not seeing any sign of them leveling off. If they continue to move lower, we think that will start to show up in some real weakening of the labor market. And that should also curb consumer spending, which again, on the whole, has been relatively strong. But if you dig down into what consumers are spending on, it is an increase in a lot of sort of must-haves, medical bills and other necessities rather than discretionary items. So we think that the Fed will be cutting considerably more than they indicated in their summary of economic projections, which should help the market on the whole. But again, we are attuned to some weakening of the overall economic backdrop as well.
Yeah, I suppose the fact that the Fed's most fixated, in terms of the economic metrics and growth indicators, most fixated on labor markets to take their cue from there, that's a positive in the sense that, any further weakness there probably would pull a pretty strong Fed response. On the other hand, historically, when the Fed is getting more aggressive in terms of easing to prevent a downturn, that's when stocks struggle. How would you reconcile that, Megan?
Yeah, I think if the Fed is easing because the labor market is deteriorating, that could be a concern. But we think that we can still strike the right balance and achieve that soft landing. Our GDP forecast is just a little bit below consensus for next year, but we think that easing will help, and that could be very different from what we've seen historically, which is that the Fed's more often than not been behind the eight ball. They've been cutting when it's too late and when the economy is heading into recession. But a recession is not our expectations. We think it could still be a good year for equities, just probably not the returns that we've seen over the last couple of years. So a little bit more about staying invested. We are modestly overweight to our benchmark, but really just sort of managing expectations from here.
Jason, as the early action, not just this year, I guess, but really leading up to the turn of the year, given you any reason to rethink the overall trend of things? Or what's your, I guess, sort of top-line observation of how you'd want to approach this year?
Yeah, I think there's been a little bit of a digestion. Obviously, momentum is really strong last year. I mean, the momentum factor in of itself was up 48% in 2024. So I think there was a little bit of digestion in the last few days of the year. And then I think what we had in middle of December is obviously we had a hawkish cut. You know, with the Fed talking about they're not going to be on autopilot in terms of lowering rates in 2025. They're going to be more in a wait-and-see mode. And I think that was another pill that the market has had a difficult time digesting over the last couple weeks. But I think as we turn the calendar into the new year, obviously where we are now, the other factor that we've been monitoring very closely, which you've talked to Tom earlier about, is obviously the 10-year. I mean, the 10-year close to 4.6. Potentially floating higher. I do think the market is potentially sniffing out some concerns around inflation. What will immigration policy look like? What's the Fed story going to look like? And what are potentially tariffs talk going to look like into 2025? And I think that has been part of the catalyst and what's been moving the 10-year. So I think that's something that's for us closely to monitor. You know, we saw what happened in 2022. We're coming off of 2 really strong years in the market. So I do think there's opportunity, particularly with earnings starting in earnest in the next 2 weeks. But we're definitely in a more patient mode as we kind of review all the various factors as we look at the markets.
Yeah, I guess, you know, the lack of policy visibility, as much as there are many expectations about what policy moves might be made, Jason, this coming year, the lack of policy visibility often causes the market to kind of migrate back toward the known quantities of mega cap tech. I mean, you know, obviously it's what happened in December. You're pretty well exposed in that area. Have you seen any reason to either lighten up there or, I guess, even press the bets?
There's no doubt about it, Mike, that obviously these names have done phenomenal in 2024, and we will be doing some trimming. I definitely don't think they will trade as a monolith as they didn't last year, obviously, with Microsoft being the laggard there, only up 12-13% in 2024. So for us, we favor Amazon as it relates to the Mag 7. I think they've really strengthened their operating leverage. You know, as I look to AWS in the cloud, I mean, the margin growth there was phenomenal. I mean, the operating profit was up 50% year over year. You know, the cloud growth was up 19%. Year over year as well. So there will be picks in that space. NVIDIA, I think, will of course be another great story, but I don't think all is well there. I don't think they'll all do phenomenal in the way that they did a lot in 2024. So you know, we're going to kind of pick and choose, but definitely looking to trim some of the high flyers from 2024.
Yeah, in fact, it's been kind of beneficial in a way that the Mag 7 have gone their own way at times and kind of kept volatility lower. It's kept the whole NASDAQ from maybe getting a little bit overheated all at once. Tom, I wonder what your thought is about the general expectations level of investors and Wall Street and strategists and such. The last couple of years, as we started January, people were able to point to a really deep well of skepticism, and you had very modest S&P targets on the sell side. You had a lot of economists saying we're at risk of recession. There's not a lot of that as we start 2025. Basically, a bullish consensus, feeling as if a lot of things are primed to work. Is that a concern?
It always is a concern because we know when you get to a top, it's because investors have now made a judgment error thinking stocks don't have downside risk. I don't think we're at that point yet because we know that shorting activity has increased pretty sharply in the past few weeks. And speaking to our own clients, many have been skeptical about how stocks can do in 2025 because they view it as a stock picker's market given the back-to-back gains. So I think the institutional universe isn't really as bullish as many believe they would be because I think many just think, you know, a lot's priced in. On the non-institutional side, I think when we look at some of the feedback from our clients, they feel pretty beaten up since mid-December. I think that sort of drawdown has actually taken out a lot of bullish expectations. So I don't think people are bearish, but I don't think they're as bullish as many claim investors are.
Yeah, that's fair. I mean, the surveys recently have shown a little bit of moderating bullishness, some of the positioning data as well. Megan, for an investor who's, I guess, got a more diversified portfolio, you're looking at this year, what stocks gave you last year, and maybe what the bond market is offering there. Are there any kind of clear moves or reorientations you think they should be making?
Well, I think for one, we have recommended and we'll probably see other investors rebalancing because you had a stellar return for the equity market, really lackluster for bonds. Going forward, actually, where you have the yield on an aggregate bond index and where we expect rates to go, you're probably looking at pretty decent annualized returns over a 3 to 5 year basis for bonds. So we are neutral to fixed income. And recently we took down our equity overweight trimming from U.S. small cap, a little bit more cautious than Tom is on the small cap space. But I would say stay underweight to cash, stay neutral to fixed income. The obvious risk is upside risk to rates, which we've talked about, and certain policies from the new administration could put upward pressure on yields. And we would look at this 4.5% level on the 10-year to add volatility, but the 5% level to really be a bit of a red flag. So as we're looking at positioning, again, it's about rebalancing, staying fully invested in equities, a little bit overweight, and neutral to bonds.
Yeah, we've only really touched 5% real briefly in this cycle, and before that, it go back a long way since we did have to contend with that. See how it goes if we get there. Tom, Jason, and Megan, thank you so much. Appreciate it. All right, let's send it over to Christina.